What do you do with the Smith Maneuver after you retire? Now, I'm going to assume in this video that you already know the basics, and you've already been doing the Smith Maneuver. So if you've been doing it for years and you've finally converted your mortgage all to tax deductible, and now you want to retire, you get this big investment portfolio and this tax deductible credit line. What do you do now? So now, if you don't know the basics of the Smith Maneuver, just go to my blog, and under strategies, you'll find the Smith Maneuver. It's the best article anywhere on the internet about the Smith Maneuver, very comprehensive. That's you learn all the different factors about it. However, this is about specifically what do you do with it after you retire. Now, okay, what we're going to learn today is what options do you have for the Smith Maneuver after you retire? There's several of them. What Smith Maneuver strategies can you do after you retire? And there's some really interesting one there. The tax implications of Smith Maneuver withdrawal. What happens if you start taking the money out? And also, how do you design an effective retirement cash flow with the Smith Maneuver? So now, first of all, you're retired. You have three basic options. Okay, so remember, you get this big investment portfolio and you get tax deductible credit line. Your mortgage is all tax deductible. What are your options? So there's basically three. One is you can just sell the investments and pay it all off. Now you're debt free. Okay, and you've got fewer investments, but you're going into retirement debt free. Another one is you can pay it off slowly instead of quickly. So you just convert your mortgage, your credit line back into a 25-year or 30-year mortgage and slowly pay it off. That way it's eventually gone. Or you can just keep it as long as you own your home and have it paid off by the home. So let's talk about those options for a minute. Now, the safest option is just sell it and pay it off. Okay. So now, the reasons you might want to consider this option is it is riskier having this, a lot of the whole Smith Maneuver strategy, borrowing to invest, is riskier when you're withdrawing and not adding new money. So it is generally a little bit riskier this way. Also, do you still have the risk tolerance now that you had? Now that you're older, so you maybe had high risk tolerance when you're saving, investing all the time, but now you're older, and do you still have the same risk tolerance? Now, a lot of people still do because you've been doing it for years. You have the same investments, and you just keep them, so it's not really a problem. But you might feel differently when you're older. Also, one thing is once you get quite a bit older, your 80s and 90s, and you think, and let's say you pass away, or so at some point you have powers of attorney that take over your finances. The thing is, will your kids or your beneficiaries or your powers of attorney understand what you're doing? Or are they going to think you're going to crazy, or are they going to come and just change it all on you? So another question. And then also, another reason you want to do it is you have your home paid off in your estate. So it's all, your estate, that's just a home paid off home, and there's just investments there, and that's all you have, and there's no debt. So, and some people just are more comfortable with it that way. That is the safest of the three options. Now, the middle option is you pay it off slowly. You convert your mortgage back to a 25-year or 30-year mortgage. So now your payment is higher because you're paying principal plus interest. Even though you may get a bit lower interest rate, your payment is still higher. And so you slowly pay it off. Now, the reason you may want to do this is some people just don't like the idea of always owing money, right? So if you just keep the credit line forever, you just always owe money. And this way, you think, well, I'm paying, it's not a lot more. You're paying somewhat more. And you know what? It's eventually going to be gone this way. So now this option does mean you can have lower retirement and a lesser tax deduction because, this credit line is slowly paying off and you're using some of your retirement cash flow to slowly pay it off. Now, the most comfortable retirement option is you just keep the Smith Maneuver as long as you own your home. Okay. Now, why would you consider this option? First of all, keeping the extra investments when you retire is huge. It makes a big difference on your retirement lifestyle. And so I've done thousands of financial plans, and the thing that you'll find interesting is between 70 and 80% of your retirement cash flow over your entire 30-year retirement is growth that you receive of your investments after you retire. You just sell a bunch of investments when you retire. You missed all those years of growth on that. 30 years or more of growth. Retirement tends to be that long. Also, it's paid off by selling your home, not by selling your investments. Okay, so your home gets sold either when you pass away or if you move to a retirement home and sell it. That's when it's automatically sold, paid off, because it's pledged against your home. Whenever the house is sold, it's automatically paid off. So in this way, your investments are there there to provide you cash flow. It's all they ever do. So that's why you get a more comfortable retirement this way. So now this method uses your equity effectively. So if you have a paid off home, it's really kind of dead equity. It doesn't give you any cash flow at all. So, and you know, like my general philosophy on real estate is the efficient use of real estate equity is to always have it as a maximum leverage. Like real estate long term grows a fair amount lower than the stock market. You know, for example, here in Toronto, the last 45 years, the Toronto real estate has had 1/6 of the growth of the Toronto stock market. And of course, US and global equity stock markets have done more. So it tends to grow slowly. So when you always have it leveraged, so you don't have much money of your own money in it, then the real estate is always used much more effectively. So you know, if you retire in it, you know, actually, just as a concept, is I did a video a couple months ago called "Millionaires in Poverty," and it's something that I see actually quite a bit of. It's people that retire with a multi-million-dollar home that's paid off, but they have almost nothing in investments. So they're living below the poverty line, and yet they're a millionaire or a multi-millionaire, and they have, you know, 4 stupid options that they can do. Right? So they can sell and rent, but they want to keep the home. So why would they sell? They can sell it. They can, you know, separate credit line and spend against it. Who wants to do that? Because it seems bad to just have a credit line and just spend it that you would never tend to pay off. You can borrow it against it to invest. Now, if you've been doing Smith Manoeuvre, that seems fine. But if you've never done it, you just want to start at retirement, it's bad, right? Or you can just continue to do what you do and have a paid off home and live below retirement. So there's 4 millionaires, the millionaires in poverty. Now if you've been doing Smith Manoeuvre, that doesn't apply to you because you've got this little big portfolio here now. But just it's a concept of how to use your home equity effectively. So now with the Smith Manoeuvre, you can still get tax refunds in retirement. So our clients, even after they're retired, even after they've been doing Smith Manoeuvre for quite a few years and it's grown a lot, they still tend to get tax refunds in most years. And that's because the you know, the interest deduction that you get in most years is more than the capital gains that the taxable income that you get from the investments. That is, if you invest tax efficiently. So, and also, you know, after you retire, you have basically no tax deductions. You may have none at all. You don't have RSP deductions or anything like that anymore. So having an interest deduction is still kind of a one really good deduction you can have. So now the tax deduction can also help you avoid clawbacks of government programs. And, you know, retired people generally are in a higher effective tax bracket in, you know, at many income levels. And I'm going to show you that in a minute. Because of all these clawbacks, there really are. A clawback is really an extra tax. So now, keeping it can give you more effective tax planning. What we found from doing when we're designing retirement income, it's really useful to have, you know, some RSP, some TFSA, some non-registered, so you get money in different places, and we're deciding how much to take from where. And you know, your taxable income and your cash income can be very different. So when you have it in all the places, it can be much more effective. And also, if you keep this Smith Manoeuvre, you know, kind of forever, you almost definitely have a much larger estate. It's, you know, it's clearly long-term investing, 30+ years of retirement. So your investments are almost definitely going to have grown a lot. So you have both the investments and you have the home. So that's how you get a, you know, a much larger estate to pass on to your kids. So now you may wonder about this. I'm taking money out. Is it really reliable taking money out of my investments? Because I still have to pay this credit line, right? So we got to do it. And so I have studied this in depth. There's a study on this on my blog about the just go to my blog and search 4% rule. There's several articles about it. So these are the success rates. So if you stay, you know, 100% or close to 100% in equities in retirement, which you should do if you're leveraging, then you can withdraw 4% a year quite reliably plus inflation for 30 years, and it is quite reliable. So you don't have to worry about, like, even though the investments go up and down, I'm taking money out. What do I do if I'm taking money out? Can you be reliable? And you can. And I'll give you, so we've had specific clients that they had their retirement goals. This is like the worst case scenario situations. So they saved up the amount they needed for their retirement goal. They retired. And then by their bad luck, it turns out it was 2008. And 6 months after they retired, their investments were down 40%. Okay, that sounds horrible, right? The worst case scenario. Now, what actually happened was we just kept sending them the income that was in their plan. And in 2 or 3 years, they had all the way back up and everything was fine again. So that's kind of that was the worst crash in 40 years, or sorry, 80 years. And yet the retirement income was still fine. Okay, so in a couple of cases, we had to reduce the retirement income by between 100 and 300 a month for a little while. And we didn't maybe increase them by inflation, but basically, even the worst case scenario, you could have a retirement, reliable retirement when you keep all these investments. So now you have to have the risk tolerance, but it is a learned skill. And basically, what is risk tolerance? People always give you these. You go to advisors, they always give you these questionnaires to fill out, and that is your risk tolerance. But it is a learned skill that you can learn, and basically, it is the ability to do nothing when your investments go down. You stay confident, of course. It's easy to be confident when the investments are going up. When they go down, you do nothing, or you invest more if you can't, and you wait. And the stock market has recovered from 100% of its declines in the past, and likely that will continue. So that's the risk tolerance that you need. Now, I told you I was going to show you the tax brackets. So these are the marginal tax brackets. So if you have this much income, you pay this amount of tax. So the first 19,000 is tax-free. This is when you're under age 64, under age 65. The next while you pay 20%, and then some you pay 30%. So that's the rates. Now, when you're retired, though, we have all these additional clawbacks. You get if you're low income, you can get this GIS, the Guaranteed Income Supplement, but you lose 50% of it. So it's clawed back by 50% of your taxable income in these low brackets. And then there's also the age credit, and the old age security has a clawback. When you add those in, these are the effective tax brackets for seniors. Okay, and you notice that a lot of them are really high, from 79,000 and up, or from 25,000 and down, taxable income. You actually have effectively very high tax brackets. So that's the tax deduction that the Smith Manoeuvre can help you maintain. So now let's talk about the strategies you can do after you retire. So there's a few cool ones. So first of all, you can have what we call an interest-only mortgage. It's not actually, but effectively it is. So, and the reason you do this is mortgages have a lower mortgage interest rate than credit lines. So you have this large tax deductible credit line, you convert it back into a mortgage. Now you get a lower interest rate, but you have to pay principal plus interest. Okay. However, we call it capitalize the interest. Now, if you've been doing capitalize the principal, if you've been doing the Smith Manoeuvre, you've been capitalizing the interest, right? You pay the interest from the credit line, and you take money back to your checking account so that the credit line is essentially paying its own interest. Now, here what's happening is you're capitalizing the principal. So you convert your taxable credit into a mortgage. So the whole mortgage is still tax deductible, right? It was taxable just because you convert from a credit line to a mortgage. If all the money was used for investment, it's still tax deductible. Now you make your mortgage payment on it, and you paid some principal. Now you're allowed to borrow from your credit line to help you make your own payment. So you could take the principal portion back out again. So you've made a full payment, you've taken the principal portion back out. So in effect, you paid interest only. Okay, so it's a cool strategy to get the lower rate. Usually the mortgage rates are, let's say 1.25% to 1.5% lower than credit line rates. So you can save quite a bit of interest this way. So now you could also do a RIF meltdown. So now RIF meltdown is you convert your RSP to a RIF when you retire, and that's the, it's the same as an RSP, except you have to take some money out every year. And all of what you take out is taxable. But what you can do is you can convert enough of your RSP so that your RIF income pays your Smith Maneuver interest. Okay, so that's paying the interest, and for tax purposes, it offsets. The RIF, it was taxable, the Smith Maneuver interest is tax deductible, that pays it, that's offsetting. Okay, now what you do is you take your Smith Maneuver non-registered investments and you take regular withdrawals from that, and that provides you with a cash flow with very little taxable income on it. Okay, so it's actually a cool way. You're basically getting an income from the investments with very little tax on it. It's not no tax, but it's very little tax. Another one is the GIS strategy. So the GIS is it's a guaranteed income supplement. It's part of the old age security program. You can get it when you're 65 or older, or even there's a way to get it when you're 60, if your spouse is over 65. But you can get between 11 and 14,000 per year tax-free income from the government. Okay, and this is about planning, because there's taxable income and cash income can be very different when you retire. And the guaranteed income supplement is based on your taxable income. However, you can still have a high cash income to give you a comfortable retirement at the same time and still get this. So we've actually helped some people that were, multi-millionaires get this guaranteed income supplement, which is supposed to be for low income people. But so they had, a high cash income, but very low taxable income. And so it's something that can be done. So now you have to plan this very carefully. So we've done this for a bunch of people, but I can tell you, you have to really commit to doing it, because if you have a large portfolio, it's so easy to trigger a bit of taxable income. And of course, every bit of taxable income, you lose 50% of it on the GIS, right? So you have to be really careful on the planning. There's a bunch of ways you can do it. You can, keep tax deductions from before that you can keep to offset it. You need a method to get the cash flow out with tax-free or very low taxable income. It's a complex strategy. There's a whole article on it in my blog. Okay, but another strategy you can do. Now, there's also what's called the Smith-Snyder. Now, the Smith-Snyder is something that a number of advisors or mortgage brokers were doing 10, 15 years ago, and where they're have investments taking money out. But essentially, as a Smith-Snyder strategy refers to doing the Smith maneuver, but having money coming out of the investments regularly. Okay, so and then now if you do this effectively, just taking a regular withdrawal from you, just sell a bit of your investments each month and take your income, it could pay very little tax on it. So, all right. Now, what happens though when you do this, generally, I'll talk about this more in a minute, but your credit line slowly becomes non-deductible as you do this. Okay, so there's a complex calculation involved in it, but it slowly becomes non-deductible. So, that does happen when you're taking money out slowly, depending on how you do it. So, but what you do is you sell them bit by bit. It's called self-made dividends. Again, I have an article on my blog about self-made dividends. It's all about self-made dividends are where they're not actual dividends, but they're better than actual ordinary dividends in every single way imaginable. And it's from you where you just automatically sell a bit of your investments each month. And you're not focusing on getting any dividend income. You're focusing on getting deferred capital gains, which are the lowest tax type of investment income. The last one is what's called the dividend strategy. Now, I run into a fair number of people that do this. Now, we basically never do this because we find it's not the most effective method, but some people just kind of feel safer this way. So basically what it is you invest to have your investments pay dividends and you live off the actual dividends. Now what happens is your investments actually control the income you get. You don't get it. It's whatever dividend they pay. But if you do that, the credit line may stay tax deductible. However, you'll pay more tax because the dividends are taxable. right? So there's a bit of a tax bleed on the strategy. So also, if you're investing in dividends, you're probably investing a bit more conservatively because you're not getting any kind of the really growth stocks in there. So you may well be getting a bit lower rate of return long term. So, and also the clawbacks on the government programs can be grossed at can be much larger because a dividend on a publicly traded company is grossed up by 38%. So you actually get this weird thing, for people that are, for example, getting the GIS income, if they get a bit of dividend income, that dividend income is grossed up. They effectively pay 69% tax on it. It's crazy. So you get, basically 70%, you get $1,000 dividend, 700 of it goes to the government, you get 300. It's quite bizarre. So now, and you need generally about, I've modeled this whole strategy over a 30-year period. And I find generally you need about a 1% higher rate of return on your investments if it's all dividend income than if you just did it with more tax efficient self-made dividends and regular equity investments. But it is a strategy that some people want to do. So here's 5 possible strategies. So now here are the tax implications when you're doing the Smith maneuver. Okay. Now, generally, it's kind of cool. You can try to keep your credit line 100% tax deductible. Okay. Now it stays 100% tax deductible if you do the following things. So first of all, you could sell some investments, but basically the amount of investments that you take out reduces the amount that's of the credit line that's tax deductible. So if you take 10,000 a year out, then generally about 10,000 of your credit line is tax deductible. Now that's not quite true because the actual rule is that it's the book value of your investments, assuming they've gone up, it's the book value of it that reduces the tax deductibility, not the growth, not the market value, but you have to be able to track that. Okay. So if you sell some investments so if you sell investments, a part of it was the money that you originally put in, and part of it was the gain. The gain amount you can actually take tax-free. It's only the book value that reduces the tax deductibility of the credit line, but you have to be able to trace this and track it properly. So, which can be a little complex. So now any taxable income, capital gains or dividends, you can withdraw tax-free. Okay, or sorry, you can not tax-free, but you can withdraw them without affecting the tax deductibility of your credit line. Okay, if the income is taxable. Now doesn't apply to return of capital. So there are some funds like T8 mutual funds and also some ETFs that pay some return of capital when they're paying. It's anything that pays a regular monthly income, a regular monthly cash flow. Why it very often pays as return of capital, and like real estate investment trusts have them as well. And that amount does reduce anything you get there, does reduce the tax deductibility of the credit line. Again, you have to be able to track it. So now you can withdraw investments to pay the tax deductible interest or investment fees. Okay, so if you're paying some interest on the credit line, you have $500,000 credit line, you're paying $20,000 a year of interest. Investments that grow into $1 million. You can take $20,000 out of the investments to pay your $20,000 credit line, and or $20,000 a year on pay the interest, and your credit line still stays fully tax deductible. Okay, and also so those are amounts you can do if you're tax free and keep your credit line 100% tax deductible. But if you withdraw more than that, then your credit line slowly becomes non-deductible, and you need to track that. So now, tracking all this, we call it a Smith-Snyder calculation. So and it actually turns out to be a huge spreadsheet. So unless you can follow these rules and be obviously clean, you need this big spreadsheet. And what happens? See, if you're doing this and you get audited by CRA, CRA doesn't go and you can send them what you calculated. But if they disagree with your numbers, if they don't think they're perfect, they don't come and say, well, actually that's not correct, here's the right amount. What they actually do is they look at what you sent, and if they don't agree with it, they just deny all the interest, and it's up to you to prove how much is tax deductible. So for our clients that are retired, if you're taking less than the interest amount, then it's fine. It all stays deductible. It's pretty clean. But anything but more complicated, you need to have this big spreadsheet. So in CRA, if they do an audit on you, you have to be able to send them this big spreadsheet that says, here's how much money I took out, and here's the interest I paid, here's the taxable investment income, and you track it over time, and you got to be able to prove all these numbers. And so we've got a large number of clients doing Smith Manoeuvre, and we usually get a couple of these audits a year on some of them. They're not really full audits; they're just more they're a request for information from CRA, and so we know how to do that. We just send in all this data for them, and it's kind of done. So you need to be able to do it, and it's kind of complicated, but it is something that can be done. Now, we want to design an effective retirement income with all the Smith Manoeuvre. What do you need to know about that? So first of all, if your mortgage is not paid off, it's nice if it's all tax deductible when you retire, but it's actually not that big of a deal if it's not. Okay, so if you still have a bit of a mortgage, you can continue to make the payments and still do the Smith Manoeuvre. So you're still making your regular mortgage payments, you're paying some principal down, you're still investing money every month, you're still capitalizing the interest, so the credit line is really paying its own interest. And so that you're still converting the last bit of your mortgage to tax deductible. You can continue to do that even into retirement. Okay. Meanwhile, at the same time, you can have your investments. You can start to take a regular monthly cash flow on your investments. Now, it may affect the tax deductibility if you do this, but overall, the cash flow is fairly similar whether your mortgage is paid off or not. And just so you understand that, what's really happening is your total debt is staying the same, right? So if you still have a mortgage and a bit of a credit line, then the total debt is the total of the two of them. If the mortgage is all paid off, it's just one all tax deductible credit line. Then you basically still owe the same amount of money. So you're just paying all the interest, and you're not paying any principal either way on it. So that's why it turns out that the total cash flow that you pay, whether the mortgage is not quite paid off or fully paid off, the total effect on your retirement income is actually very little difference. It's just a bit of extra interest on it. Okay, so that's kind of interesting when you think that you have to have it paid off, but you don't necessarily. So we do have clients where it's funny, it seems odd, but they have investments monthly going from the credit line to their investment portfolio. At the same time, they're taking money monthly out of the investment portfolio for their cash flow. So there's money going in and out of their portfolio at the same time. But it actually makes sense because they're putting the money in, keeps their credit line maxed and all deductible. Meanwhile, they're getting their retirement income, on a low tax basis. So now also the Smith Manoeuvre doing in retirement, it's actually really helpful. So, for people who are not doing Smith Manoeuvre, all they have is RSP, and little, TFSAs tend to be much smaller. And if that's all you have, then it's hard to design a retirement income. If all you have is RSP and pension, every dollar you have is taxable. So it's hard to design something to be tax efficient, especially if you want to take a lump sum now and then for a big trip or to buy a car or for renovation or something, then those will all be taxed at a high amount. So, but if you have money in a bunch of different buckets, so you've got some RSP and some TFSA, and you've got non-registered investments, maybe Smith Manoeuvre, maybe some others that are not leveraged. So you get money in different buckets, and you can decide to take money from the different places. And it's actually really cool. So when we design retirement income, we're looking at there's your taxable income and your cash income. And they can be really different. Like you think income is income, but it's not. They can be widely different. Because if you take RSP, of course, they're the same, but TFSA, there's no tax. If you take it from the Smith Manoeuvre, you trigger a little bit of a capital gain, but depending on what you do, but there's generally pretty low tax on the regular withdrawals from non-registered investments. So you can design them. You can design a very efficient, tax-efficient taxable income that way. So, and again, so withdrawing the most effective way to do it is you just automatically sell a bit of your investments each month. It's called Self-Made Dividends. Again, an article on my blog about it. And it is the lowest taxed type of investment income. You just sell a bit of your investments each month, and then make sure that you know how much of it stays taxed. Your credit line stays tax deductible, but this way you get your taxable, the retirement cash flow that you want, and yet pay very little tax. All right, so thanks for listening. So what you learned today is what options do you have for the retirement, for the Smith Maneuver after you retire. You learned about a number of different strategies that you can still do, and all these tax rules that you need to know once you start withdrawing from the Smith Maneuver, and you learn how to design an effective tax retirement cash flow with the Smith Maneuver. Okay, thanks for listening. So my name is Ed Rempel, and my blog is Unconventional Wisdom. It's the #1 financial blog in Canada for a financial planner, and it's edrempel.com. If you enjoy this video, then please like and share it, or subscribe to it. So there's both my blog and my YouTube channel. If you subscribe to them, all that happens is it means that you will get my new videos and my new articles sent directly to your email every week as they come out. Thanks for listening, and we'll talk to you next week.